is the worst of the slowdown behind us? Will the next quarter numbers reflect that the economy is bouncing back? Or are we very worryingly headed towards a period of stagflation? Let me put that question first to Mahesh Vyas. 4.5% was the growth rate of the GDP in the second quarter. Everybody's faces fell, hearts broke. Is this the worst? Because we are now closer to what used to very cryptically be called the Hindu rate of growth than the Modi promised rate of growth, which is double-digit growth. So we're closer to 3.5 than we are to 10. Is the worst behind us? Will quarter 3 for the Indian economy be better than quarter 2? Mahesh.
Well, I wouldn't venture to forecast the GDP growth rate. There are problems with the way the GDP growth rates are calculated, and there are complications over there. I wouldn't like to get in over there. But I can still answer your question another way. I don't think we are seeing a bottoming out. I don't see this to be a point of inflection where we will see a turnaround now. We are seeing the worst growth rate and things will be hunky-dory hereafter. The most important sign has to be that investments have to pick up. And I don't see any sign of the investment picking up. We are into a situation where a persistent fall in the investment rate from 2011-12 all the way till 2018-19 has led to a fall in the growth rate of consumption. So investment slowing down has led to a consumption slowing down, which now is actually kicking back into people not investing. So where will you come out of this from? It cannot come out automatically. There's no low point from which you can bounce back automatically. So I don't see any sign of any kind yet on the horizon to say that we have bottomed out and something is going to come back again.
Samiran, do you see signs of a recovery? Do you believe the worst is now behind us? And why do Indian economists keep getting their GDP forecast so horribly wrong?
Well, let me take that blame first. As in my 20 years of covering markets, I think this is the largest intra-year growth revision that I've ever done. I started the year with 7.1 and now down to 4.9 for the full year. I don't think a 220 basis point cut in GDP forecast we have ever done. And it makes us think that is this slowdown somewhat different from the rest of the slowdown that we have seen. So my surmise is that the last 4 or 5 significant growth slowdowns that we have seen have all been supply side shock led. This is the first demand side slowdown we are seeing in a big way, because we always thought that India is a supply constrained economy. Demand is never a problem for us. So once this demand slowdown comes in, it becomes difficult for us to model that because we are not used to seeing demand slowdowns. And that's probably one of the reasons why we got this horribly wrong. But to answer your question that can we see a bounce back, I think the most critical question for me is how much is the difficulty in the informal sector, which we don't have high frequency data to judge. Because I'm pretty sure that the formal sector, with the kind of stimulus that has been given, would bounce back. It's tough to say whether it is a 2-quarter issue or a 3-quarter issue, but it will bounce back. The informal economy is where my doubt is, because I don't have aggregate macro data to analyze that properly. And if the stories are true that that's a segment which has gone through, to use the phrase that you are using here, disruption, or at a worst case die, then that might not respond immediately.
So you don't think the worst is necessarily behind us? You're still looking at 2 or 3 quarters for the economy to start picking up. So Kanti Ghosh, the last time something like this happened was when the Lehman Brothers crisis happened, and the economists at that time didn't know what would happen next, because that was really a black swan moment. Here, since demonetization and the announced rollout of GST, there hasn't been a sudden situation where the economists have to deal with an X factor which they hadn't factored in. So why did economists get so many of their numbers wrong? You've now revised your calculations very, very drastically. Do you believe that the second quarter numbers is the worst, or do you think the economy, as Samiran fears, will struggle for a couple of more quarters before bouncing down?
Yes, I think we have also revised our forecast from 6.9 to 5%, and possibly there could be a downward bias. But not only GDP, I think if you look into the Indian economy in the last 2 to 3 years, I think even the inflation forecasts have gone horribly bad. I mean, from 5% to 6%. So, and the reason is that the economy actually has been going through a lot of changes. Not only inflation, not only global growth, not only domestic GDP, there is a lot of uncertainties which are impacting the economy, and sometimes it is difficult to predict how these uncertainties going into a macro modeling. If I give you an example, say earlier when you used to do the growth projections, oil was always an important factor in the projections. But today, oil prices which are $86 a barrel in 2018, today they have crashed to below 50, now they're around 60 to 65. So in a situation when oil prices vary like this, I think sometimes it gets very difficult to predict the projections. Now in terms of whether we have reached the bottoming out, my sense is that there are some sort of green shoots happening. For example, there has been an pickup in credit growth, even though that's marginal. The global growth possibly will 2020, we may not be looking into a global slowdown, so that could actually positively impact the Indian economy. And the final thing which I base my optimism is that markets never lie. So if you look into the financial markets, at the end of the day, the financial markets, if I put it very plainly, it's only a discounted value of the future cash flows. So if you see that there is some potential in the cash flows, that's why the markets go up. I'm not sure whether I can connect the financial markets with the current growth rate because they're moving diametrically in opposite direction. But at least if I put that thing into perspective, I have hope that possibly we may have seen the worst of the rates.
You know, as political journalists, we put out exit poll numbers and you work really hard and you hope that your models are right. Usually they are, sometimes they could go wrong. With economists, you believe, Dr. Goyal, that the economists have it better than the political pundits and they're more likely to get their numbers right, but that's not been the case. Why is that? Do you believe some of the withholding of government data and government reports has really left economists dealing with numbers which could be true, may also not be true? And what's your view on whether the worst in the economy is behind us?
Yeah, I think the economy is going through structural change. And that is why data, we don't know what we are measuring. It could be overestimated, it could be underestimated. So in a way, I am pleased with the latest, with analysts getting their forecasts wrong. Because earlier they were tracking high frequency numbers and saying these are showing that growth should be lower than the CSO is telling us it is. And this time they were actually saying it is higher based on high frequency numbers than the CSO came out with. So it suggests the CSO is not seriously underestimating GDP. We are not actually growing at 2 and 3%. We are growing at 4.5%. So I think this criticism of the CSO has been overdone because in an economy like India, which is very diverse, we still have a non-modern sector, non-formal sector where it's very difficult to get data. There are more than 600 surveys which are used. And to forecast GDP growth on the basis of some regressions or demand side, a lot of the analysts use consumption, investment, and so on, where the data problems are immense compared to the supply side. Supply side estimates are more reliable. Then there are problems with the consumption data, for example. The NAS shows much higher consumption than the NSS survey shows, the national income data. So now to come to your, I think that we are getting there. We are getting a better feel of the changes conceptual. For example, industry. We're moving from a 4,000 firms database to 3 lakh, out of a 12 lakh database. Then, and that was the big surprise in GDP growth rate. But you need to do that. You can't see what's happening in an economy the size of India with 4,000 firms. And how many firms do we have? And that is why when people say that growth rate is falling, but I agree with Soumya that the level has gone up so much, the diversity of the economy, that there's so much happening. You know, it's very different to what we were with the Hindu rate of growth. It was a very low level. At a higher level, if you have a lower rate of growth, that still means a lot of change. So then about whether we are seeing change, whether we've bottomed out or not, I think to answer this question, we have to look at what caused this slowdown. Now, I don't agree with Soumya that this is the first time we're seeing a demand-side slowdown, because the global financial crisis also was a demand-side slowdown. You know, there's a sentiment, investment fell, consumption fell, everything. We say that the markets, we're supposed to reform, the markets are supposed to lead us, but whenever there's trouble, they look to the government for help. Because there's a fear, the sentiment factor. So that was a big thing after the GFC. And this is global coordinated macro stimulus. It was the first time Indian macroeconomic policy was pro-cyclical. Both the fiscal deficit rose, interest rates were cut sharply, liquidity was pumped in, and growth rate rose from 6.7% to 11.1% the next year. It wasn't measured properly, so we didn't know we were growing so fast. There was overheating. That's why counter-cyclical macro policy can really work. And today, because we are bound by inflation targeting and FRBM, there's a limit. But in a way, it's a good thing because that was overreaction. We did too much stimulus. Part of the reforms is moving to better systems where there is, you're more calibrated and as markets deepen, you don't need to give such a large stimulus. And I think the immediate cause was really the slowdown in NBFCs. They were providing credit to a lot of hitherto excluded sectors. That demand slowed down, so consumption slowed down, therefore investment slowed down. Again, I don't agree with Mahesh that investment has been slowing down since 2011. It is true, after the tightening, after the overheating, investment fell drastically, but in 2014 there was a rise. Then after that, there was a global commodity price fall, but interest rates did not fall, and so policy was pro-cyclical, and that probably affected investment. But today, although the rate cut is limited by inflation targeting, but liquidity. The other problem was in 2018, you had the Fed raising rates, outflows, and therefore there was aggregate liquidity tightening just at a time when NBFCs sectoral liquidity tightening. So both of these came together. And if you talk to people in the market, they say, you've never seen conditions like this where there's just no money. So now liquidity is again in surplus, durable liquidity. And there are measures, government measures take some time to work. But part of this listening and calibration is adapting those liquidity measures for housing, for allowing BB-rated NBFCs also to benefit from the government warranty, which is the feedback, the correction, which will allow